Accounting 121, Chapter 6. In Chapter 6, we talk about various cash management procedures. First, we're going to look at internal control systems. So internal control systems are created to protect our company. So they're policies and procedures used to protect our assets, ensure reliable accounting, uphold company policies, and promote efficient operations. How internal operations or control came about was through the Sarbanes-Oxley Act, which requires managers and auditors of public companies to document and certify the system of internal control. So the Sarbanes-Oxley Act, or SOX Act, came about as a way to help prevent fraud. And one of the ways that we can prevent fraud is by having good internal control processes. Make sure that our financial reporting is accurate and complete. We also have the Committee of Sponsoring Organizations called COSO. So COSO asked that these internal control systems, we look at various things: the control environment, risk assessment, control activities, our information and communication of policies and procedures, and how we monitor that environment. So how do we monitor our internal controls? What things are we controlling? What is our risk for fraud in those various activities? How do we control them? How do we inform? And then how do we monitor? So when we're looking at the principles of internal control, we want to do all of these things. So establish responsibilities. When we're establishing responsibilities, we're looking at who is responsible for the management of that asset or those records, who is responsible for holding cash, depositing cash, ensuring that cash is recorded correctly, that we're maintaining adequate records. We insure all of our assets, so our equipment and property is all insured. We bond our employees, so that is essence that we certify our employees that they can have access to the cash and that they're insured if there's something with theft or anything like that, as long as that is not fraud. So separate record keeping from custody of assets. What separate record keeping from custody of assets does is it says that the person who records or collects the cash and from customers, so maybe if we have a service company or merchandising company and we're selling items for cash. So what that says is the person who collects the cash should not be the same person recording how much cash is in the journal entry. Or the person writing checks should not be the person responsible for recording those journal entries. So dividing responsibility, which helps then prevent fraudulent activities. So if the person collecting the cash from customers is also the person reporting the cash and depositing the cash, it's more likely that that person is able to commit fraud in regards to that cash. So they can alter then the records that say how much cash should be there. Tech controls are locking down systems, locking down who has access to systems, and the more technology we have, usually the more secure reporting environment that we have also. Then we also want to perform regular and independent reviews. So we have an internal audit process where we look at our internal control, how we manage internal control, how we function. Our internal auditor is going to look at our processes and procedures. And then we also have external audits. So one of the SOX Act rules also requires an internal independent audit. What independent means is that if a company is paying someone to do their accounting, that accounting firm cannot also conduct their audit. So they have to have separate accounting firms do their internal records and financial statement preparation and their audit. It also has a statement that they should change auditors every so many years so that that relationship remains independent. Our auditors don't just get in a group of where they're just saying that things are okay. So when we look at that established responsibilities, we should have clearly established tasks that are involved in our cash asset responsibilities and in any of our asset responsibilities. Those tasks then should be assigned to just one person. This allows us to determine who is at fault then if something happens at that responsibility level. So if I have a person who is tasked with collecting cash from customers, and that is the only person that can collect cash from customers, then if there is an issue with the collections, I know who I need to talk to in order to determine what that issue might be. Maintaining adequate records. So this helps us monitor our activities and protect our assets. One of the things that we can have with maintaining adequate records is making sure that we have pre-numbered sales slips, pre-printed forms, computerized point of sale systems. So it's more difficult when we have these mechanisms in place to complete fraud. So one of the ways that fraud sometimes happens in companies is through the use of fake invoices or fake sales slips. By pre-numbering our sales slips, it's easier to spot a fake sales slip by the number. The numbers will be off and we can catch that. Additionally, having a computerized point of sale systems or cash registers makes it difficult to also say that a sale didn't happen. Another good example of fraud using cash would be in fast food industries. If I don't ring up all of the items, but I collect cash for all of the items, and then I would pocket the difference. So if there's 6 items, I tell you the total for the 6 items, but I only ring up 5, then I can pocket the cash for the difference between the 5 and 6 items because that sales system is only going to show the 5. By having screens that are available to the customers to look at, the customers have to authorize, yes, that is my order, everything is on there, and it's less likely that those point of sale fraud activities will occur. Then we have insure our assets and bond key employees. So assets should be insured at all times. Our property, plant, and equipment should always be insured. Bonding our employees means that the company has purchased an insurance policy against theft by that employee. So if employees have access to a lot of cash or assets, they should be bonded, or the company should have an insurance policy against them so that if that employee does fraudulent activities and steals from the company, they have an insurance policy in place to recoup some of that money. Separate record keeping from custody of assets. So this is the person who controls or has access to assets shouldn't be the person who has access to the accounting records. So this helps reduce theft or waste of an asset. So if my person who is checking in inventory coming off of a truck shouldn't be the one who gets to record that inventory in the accounting records. I should just have to say, yes, we received this, or no, we didn't receive this, and I'm checking it in. If I'm able to record it in the accounting records, then it's easier for me to put inventory aside for myself to take home that doesn't get recorded in the accounting records because I have control of both the asset inventory and the accounting records for inventory. So that's separate record keeping. However, employees can collude. This is when employees agree to commit fraud together. So they collude to circumvent any internal control policies that are enacted.